Hi guys, Will here from WB Trading and welcome back. If you're new to the channel, please do hit that subscribe notification and tap the bell icon so that you don't miss any of the free content I share with the trading community here on YouTube. So today's video is one I'm really excited to share with you all because it's going to specifically focus in on, firstly, the aspect of trading that made me profitable, that being finding my own sources of edge and turning these into viable trading strategies. And secondly, I'm going to guide you through exactly how you can do this for yourself in as much depth and detail as possible. Before we get started though, I've put a huge amount of time and effort into putting this together. It's been about a week's work now for you all. So I just want to ask a really quick favor. If you take just a second to hit the thumbs up button, maybe leave a quick comment as we move through the video, that would be a huge helping hand and I would really appreciate that. And as this in-detail training video will be on the slightly longer side today, do feel free to pause this video now, nip off, make a cup of tea, a cup of coffee, whatever it is that you like to drink, and grab a pen and a piece of paper too, as you'll definitely want to make notes as we move through the video today. And hopefully you'll all take at least, a few nuggets of key information from this training video today that'll help to trigger some inspiration, increase profitability, or at the very least help you to up your trading game in some way today. That's my reason for putting this together. Just to hopefully, help you take that next step in growing your trading business and or your trading account. And I can almost guarantee that if you watch this entire video beginning to end, you'll learn something that will help you up your trading game. So with that said, let's get started. So what is an edge, or what does edge even mean, and why is having an edge so crucial to success as a trader? Well, I had an email recently from a trader who's unfortunately trading real money at the moment, and she asked me, Will, you always talk about edge in your YouTube videos and on Twitter. What is it? What does it mean? And this was a bit of a scary email to receive because if you're trading without edge, let alone you don't even know what it is or what it means, I hate having to say this, but you're almost certainly going to lose money in the long run because, well, we're about to touch on why, but maybe that's you. Maybe you thought the same or you're thinking the same and asking those same questions. So let's solve this problem and define edge. So an edge is, or edge itself, means that statistically, over a large enough sample size of trades, you're always going to come away profitable, ahead of the market. It's probably best to give you a more literal example, and I'll try to keep this fairly simple, but to do this and to give you an example of edge, let's take a look at the roulette wheel. Now, most people think that when playing roulette, they have a 50-50 chance of being right or wrong, and therefore that winning is more down to chance. But this isn't the case. If we look closer at the below wheel, you'll see there are 18 red pockets, 18 black pockets, and crucially, 2 green pockets. Now, what this means is the statistical chance of a player winning is roughly 47.3%, and the statistical chance of the casino winning is just above that at roughly 52.7%, which gives them a positive expectancy and gives customers a negative expectancy. And therefore, the casino has an edge over you, their customer. So hopefully the importance of edge and how it works is starting to become slightly clearer. Now, I'm sure you've all heard the saying, the house always wins, and this is due to the above, as the casino, like we've just seen, has a statistical edge, albeit a fairly tiny edge, but it's an edge over clients nonetheless. Think about this. Why is it, do you think, that casinos are able to give away free food, free drinks, even free hotel suites to their best clients? It's because they know full well that in the long term, as their edge plays out, their customers are going to lose money and they're going to make money. And the more customers that come through the door, the more trades they make, so to speak, the quicker their edge is going to play out and deliver profits. Now, again, this might happen slowly, and in some cases, customers in a casino will get lucky and, maybe have a winning streak that'll last a whole day, maybe even a whole week. Maybe time after time for quite a while, Winning runs can really run on sometimes. But in the end, luck always runs out. And, a player within a casino will either give back most or all of their money losing every penny they have to the edge within the casino. And this is why edge is so important, because in the end, and over a large enough sample size, edge always plays out and delivers profit. So it's crucial that as traders, we make sure we are the casino, so to speak. When you have edge, from there, all you have to do is let this edge play out. And, depending on the size and strength of the edge, this will depend on how quickly the profit actually shows itself. Now, what do I mean by that? What do I mean by the size and strength of an edge? Let's discuss this in more detail. It's actually quite simple. What I mean by that is, what's your average win rate, for example? Let's discuss a completely random fictional example. So imagine that you literally buy a market at 9 a.m. every morning with a 10 pip stop and a 20 pip target, and 55% of the time you achieve target, banking 20 pips, achieving 2R or 2 times your risk, and 45% of the time you get stopped out and lose 1R, or just the 1 times your risk, losing 10 pips. If you take 10 trades, or even 20 trades perhaps, anything could happen. The markets are fundamentally random in the short term. You could even, in a worst case scenario, lose every trade, although that would be some very bad luck. But more realistically, across, let's say, 50 trades or 100 trades, you should see or begin to see your edge play out. And if we take a binary 100 trades, for example, you'd be looking to see the following. So 45 losses at minus 10 pips, equaling a loss of minus 450 pips, and 55 wins at 20 pips, equaling a win of 1,100 pips. And that gives us a net remainder of plus 650 pips of profit, delivered by your 55% win rate edge. Now, trading or betting in a casino, it's not binary, and unfortunately, win rates fluctuate. Luck plays a part, and both winning streaks and losing streaks can and will happen. But overall, over the long term, as your edge plays out, you will always profit. And that's why we must trade with edge. That's why if you're trading without edge, the market will only ever take your money away from you over the long term. Now, things like risk do need to be factored in to allow for swings in win rate and winning runs, losing runs, but we'll touch on that later in the video. So let's come back to win rate for a second, as from experience, this trips a lot of new traders up. You might be thinking, okay, so Will, you're saying I need a win rate of at least 50% or slightly above, like the casino, right? Well, not quite. So you also need to consider the size of your wins. As an example, if you win 4, 5, 6 times what you risk when you're right, but you only lose your risk when you're wrong, you could have a win rate as low as, well, pretty low and still have edge. And don't worry, if that didn't quite make sense, let's look at another real life example together. Let's take my D1 swing strategy, for example, because this is a lower win rate strategy, so it's a good approach to use to explain how a lower win rate strategy still has edge and still very much delivers profit. My average loss by the strategy is roughly 0.6R. So if I risk £10 on each trade, I typically lose around £6 if I'm wrong, and my average win is around the 6R mark. So again, risking £10 on each trade, I typically win around £60 if I'm right. So again, let's take the win rate, which is around the 34% mark, and let's look at another binary 100 trades taken using the strategy. So 66 losses at 0.6R equals minus 39.6R. And 34 wins at plus 6R equals 204R, which obviously leaves us with a net remainder of 164.4R. But it sounds backwards, doesn't it? To a new trader, if you say you should expect to lose almost 70% of the time, they're probably going to think you're crazy to be trading the strategy. And yet it's one of the most profitable strategies that I trade, because when I'm wrong, the losses are just tiny. And when I'm right, the wins are absolutely huge and really help to build a trading account. And again, it's edge and it's the statistical advantage and the positive expectancy that provides that growth. So hopefully by now the concept of edge has become a lot clearer for you. The importance of a positive expectancy has become a lot clearer for you. And you'll understand why both are crucial if you're to trade profitably. So let's move forward. How and where might you find a source of edge? Simply put, where can you get one? Right, this is where it starts to get exciting in regards to finding your own sources of edge. But before we go any further and we take a deep dive into discovering sources of edge and building your own trading strategies out of these, I know that for a few of you, the next part of this training video might become slightly overwhelming, slightly too complex. And look, if you're a trader who's thinking, well, thanks for explaining edge, but I don't have 10 hours a day, 6-7 days a week like you do to build data and research the markets and so on. Where can I just get my hands on a strategy that provides edge today so I can start trading profitably? If that's you and you're asking that question, look, don't worry, I've got you covered. Head over to my website. The link is in the description. Head over to the Join My Community page and you can join me in trading any of the strategies that I trade myself without needing to do any of the hard work. I've done it for you. I do charge a small fee for sharing these, and that's because I've done all of the hard work for you and saved you the days and weeks and months of time spent digging and building spreadsheets and all of the stuff we're going to get into in a second. But the strategies will allow you to gain edge and trade profitably now with no more time or money wasted. So if that does sound like it would help, that's there waiting for you over at the website. But for all of you who want to put in the hours and do the hard work, let's get into it. So finding edge for me starts with occurrences. What we need to look for are perhaps patterns or price sequences or the likes that take place either more often than not, or even if they happen infrequently, but when they do happen, they offer a very high risk reward trading opportunity. These are also occurrences that we should be considering and taking a closer look at. Now, what we'll do in a second is literally take a look at how I do this by using a fictional example together live. And I'll show you exactly how I do this. But before we get into a live example, here's a rough breakdown of my process. So firstly, identify an occurrence, build a corresponding spreadsheet, log the data, of course, evaluate the findings, and with 6 to 7 months of data in hand, what does this tell us? Is the edge valid? Is it invalid? And from there, I usually turn back if it doesn't work, or go further if it either does or it's beginning to look like it could. Right, what I'm going to do next is literally walk you through the process I use to examine a potential edge. And just bear in mind, this is a completely fictional occurrence that I've just thought of on the spot, which is going to be buying euro dollar at 9 AM on a Monday. With the occurrence noted and in mind, we now need to do two things. One of my favorite things, which is get together a spreadsheet and of course a euro dollar chart. So let's get these loaded up. Right, so we'll start with a spreadsheet. It's always my favorite place to start. Always a good place to start. Come over to my broker IG and let's get euro loaded up. Brilliant. Get this into perspective. We'll stick with the 5-minute chart. Let's get this neatly lined up. Right, let's get the columns labeled. Obviously, we want to know the date of the occurrence, the time. In fact, let's start with rough MAE, yeah. Rough MFE. And if you don't know what these stand for, they stand for maximum adverse excursion and maximum favorable excursion. Or in other words, how far price moves in your favor or against you when you execute and take a trade. Really useful stats to know. Get these neatly formatted. And off we go. Right, so we'll start with January 7th. And again, we're marking the 9 AM open. And we're just going to, buy euro at 9 AM and see what happens. you know, let's experiment. So opening price is spot on. Now let's see what we've got. So I mean, this looks like a fairly promising start potentially. Date 7th of Jan. Let's make this tiny bit smaller. And we've got a price of 11,431 spot 4. And if we take a look firstly at MA, so how far price has actually moved against us after execution. And we'll take a look at MFE. So what have we got? It's 44 pips or so. I'm not going to be exact here, guys. I'm just going to kind of, you know, just zip through this. I don't want to be, you know, keeping you here all day long. But that's the first one done. So let's skip forward to Monday 14th. Get zoomed in. And once again, we'll mark the 9 AM opening price. This does not look like a particularly favourable session for this edge. What have we got? We've got an MFE of about 5.5 pips, haven't we? Say 5 pips. And MFE. We've got around about 25, haven't we? So just jot that down. And entry price 11,475 spot 2. And that's the 14th of January. Done and dusted. Right, let's skip forward again. Monday 21st, let's get zoomed in. We'll just do a couple more examples, then we'll look at the data. And we're going to have nowhere near enough real data to kind of actually say whether this works or not, but we'll just use this as a quick example. So again, favourable, about the same really, isn't it? About five pips or so. And then adverse is around the 16, 15, 16, about 16 pips or so. That'll do for now. And again, 11,374, 21st of Jan. Right, so we're kind of starting to build a picture here, aren't we, slowly? Nothing conclusive yet, but let's do one more and then we'll see what we've got. So let's skip forward. Monday 28th. I'm glad those birds have stopped tweeting. There we go, 9 o'clock marked. And again, similarly to the 7th of Jan, this looks a little bit more like it. What have we got? We've got a rough. Yeah, so we had no position drawdown there at all, which is pretty good, and another fairly large favourable excursion. 11,400 spot 8 on the 28th. Let's get rid of these. Right, so what have we got? What can we see? Well, we've got something here from these 4 trades. I mean, looking at the MFE, you know, we've got quite a lot of movement in our direction within these trades that we see here on the spreadsheet, and not a huge amount of adverse excursion. Let me just get this written in. So possibly buy with a, say, 10 pip stop could be an option. 2R target perhaps, 3R, 4R. These are the things that I'd now start to test, to kind of delve that little bit deeper into this. Let's see, I mean, if we did say, let's buy at 9 o'clock with a 4R target, for example. I mean, looking at these trades, this very, very small set of trades, I mean, if we were to label this, then put achieved, and then we'd make 4R on the 7th, we'd get stopped on the 14th, stopped on the 21st, and we'd make another 4R on the 28th, and so on. Now, again, tiny sample size, no saying that this works whatsoever, completely random example, but you start to see what might be possible, don't you? And, what will and won't work. And from here, you just kind of expand, Does it work on other markets, perhaps? All the things that we've covered and will cover in a second as we move through the video. So you can begin to see how that edge might just be viable, even though we've built nowhere near enough data. But the ideas are beginning to form, aren't they? We're thinking about potential stop distances. We're thinking about potential target distances. What kind of achievable R target we should be considering based on the average MFE and so on. And long story short, that's my process. That's what I find myself doing fairly regularly in the constant pursuit of new sources of edge. So let's say you've taken the time to build perhaps 6 months to a year of data. You'll know things like the absolute maximum MFE, the absolute maximum MFE, and so on and so forth. And you might begin to then look at changing the time of day, the time frame for whatever reason. And what I do is just slowly begin to optimize. But one point I should make is be sure to rely on the data rather than ideas or random thoughts, and just be sure to test everything. Right, next, taking the findings forward. If it works, trade it. Sounds simple, but it's true. If the stats are pretty much screaming out at you that you found something that works, it's time to begin gluing this together and building a strategy. And we're going to walk through exactly how to do that later in the video. But on the other side of this, if you're not getting anywhere, hey, that's fine, that's going to happen. If this was easy, everyone would be trading profitably and 80% of traders wouldn't be consistently losing money. So don't put yourself down if you're struggling, just lay it down, move on, and just carry on looking elsewhere for other ideas. If, on the other hand, you're kind of halfway and you found something that's beginning to look promising but isn't quite there yet, consider asking the following questions. So, might the edge work better elsewhere in another market? Perhaps a less volatile market, a more volatile market. Perhaps you're finding the current market too choppy or too flat, etc. How could losses be reduced? Could you add an extra parameter? Could you add an indicator? Add in reading the tape, perhaps? Or on the other side of this, how can wins be increased in perhaps size or frequency? And so on. Just ask questions. Answer these as best as possible. And if it still doesn't work, go back to step 1, repeat. Start again. If, on the other hand, it does seem to be working and the stats are clearly telling you something, it's time to turn this into a strategy that you can hopefully take forward, trade with confidence, and if you've identified an edge, you'll profit from this and it's job done. So, next, building the strategy. By now, you should have built a solid sample size of data across varying parameters, i.e., in the case of the edge we just looked at on euro-dollar, you'll have looked at different days, different times of the day, different time frames, maybe even different markets. You'll have your stats to hand, you'll have your data. You might have started to look closer at perhaps adding in additional parameters, perhaps, indicators, again, reading the tape, etc. And if it's all looking solid, it's time to implement rules and build a strategy. So step 1 is putting clear rules in place. If you're going to make it mechanical, that is how I do myself. And what I mean by this is settling on all of the above and laying these down. And that might look like this. So buy euro-dollar at 9 AM on a Monday with a 10 pip stop, and a 40 pip target, and only execute if we're above the 200-day moving average on a 4-hour chart. You know, those might be your rules. And with these in hand, you'd now begin to rerun the data using these rules. Now, from there, when you've rerun, let's say, a year of data, you'll be able to make note of some important stats, i.e. overall profitability and win rates as two examples. So if you begin with, let's say, £1,000 risking 1% per trade, how many R did you achieve within the last year? What was the rough variation in win rate as you move through the year? What's the average win rate, win rate looking like? You know, what's the current win rate looking like? And so on. And the next few questions to ask at this stage would be, does the strategy yield a viable, acceptable return, you know, per month, per quarter, over the last year, you know? Does it make sense to put your time and your money on the line? If the strategy is making, for example, 2R per month, perhaps not, you know, but if it's generating 10R per month on average, then, you know, perhaps so, and so on. Is the strategy physically tradable? I.e., are you going to miss key setups? Are you physically able to take every trade required? You know, in the above case, if you start work at 9 AM on a Monday, like most people, are you able to take the trade? If you drive a bus, for example, you might not be able to take the trade because you'll most likely be driving at this point, and so on. So make sure that you're actually able to execute professionally. Think also about outliers. You know, does the strategy's profitability depend on a very few large wins? And ask yourself, you know, what if you miss these? And so on, because, you know, with some strategies that can really damage the edge. And by this stage, it's pretty much job done. You know, you've either landed on a profitable, viable strategy that clearly provides edge over the long term, or you haven't. If you haven't, then you'd be skipping back to stage one. And if you have, brilliant. You know, you've done the hard work, and the hard work's paid off. You know, you've built your own strategy, and at this stage, you can then take it live, perhaps with a small account to start with, and you'd execute for, let's say, 3 months, 6 months, following the rules to a T, letting the edge play out, and in a best case scenario, you're profitable as you've been through the last year of data and you've cracked it. Now, some edges and strategies do come and go. Other edges and strategies seem to just work and work. And like we said earlier, losing runs will certainly happen, winning runs will certainly happen, and everything in between. But it's typically pretty obvious whether you have edge or not, because over every, say, 50 trades, 100 trades, you'll be profitable every sample size, and your account balance will of course reflect this, as long as you're managing risk. You know, if you're risking 5% or higher, you know, all it takes is one bad losing run, you know, 1 or 2 strategies combined, and you might never be able to come back from that, you know, account size dependent. I mean, if you draw down 50%, 60, 70%, you have to, well, you have to more than triple your account, don't you, to just get back to break even, which is not where you want to be. So, you know, manage risk, basically. This is a conversation for another video, but just manage risk, okay? So that's the end of the training video. I hope that's been useful. I hope that's been helpful. I hope that I've done enough here to get across what I was trying to in regards to understanding edge, how to find edge, how to build a viable strategy, and so on. But if you do have any thoughts or questions on any of the above, please do visit the comments section below the video. It'd be great to hear from you. I'll happily get those questions answered for you. Please do subscribe if you haven't. That would be very much appreciated. And as always, guys, trade with edge, with consistency, and I look forward to having you back here on the channel soon. Thanks, guys.